In the world that I live in, probably the world that you experience if you're watching this channel, it is really common to have negative views on Western countries and especially probably a strong bias against the United States. Now, it's pretty clear that by some metrics, the United States has been getting worse over the last while. There's definitely rising homelessness. I lived there in 2002, and if I look at the places where I used to live, I think by many metrics, they're worse off than they were. Now, of course, technology has improved, and so that's advanced people's lives in some respect, but you see growing wealth inequality, you see rising issues of unaffordability. I just saw the stats earlier today. Only 16% of homes are affordable with a median income these days, which is a low over a very long period of time. And so there's plenty of reasons to be bearish. On top of that, you have a situation where there's increased polarization. There seems to be greater weaponization of the legal system over the last while. You see kind of attacks by regulators, et cetera, going after people like Elon Musk. There's certainly a lot of accusations of this with respect to how Trump is being treated. There are certainly concerns about the immigration system and what's going on at the border. You have massively rising debt issues. And so when you look at this, you can ask the question of, is the US in a period of irreversible structural decline? And to me, the thing that I think you have to be pretty aware of, I try to stay away from kind of a lot of the anti-Western biases, in part because I don't think they fully account for just how screwed up other parts of the world are. There's a lot of corruption in a lot of places. There's a lot of problems in a lot of places. It's easier to have a grass is greener on the other side approach. And yet, one has to ask, is the US a fading empire? I think it's pretty clear at this point that Europe has gone past the point of irrelevance. The relative GDP of the EU has been declining very rapidly, and it's been quite a while since European nations have been major powers. They've sort of tried to forestall that by forming a union, and that maybe helps a little bit, but then they've layered on a bunch of things that seem pretty much focused on trying to make the EU the least business-friendly place on the planet, which doesn't seem like a great idea. The US, on the other hand, although it is down a long ways in terms of relative GDP from its height, which was basically 1945 post-World War II, has actually remained relatively steady and has been relatively resilient. You're also in a situation where it is really clear that entrepreneurial dynamism, depth of capital markets, and things like this remain pretty much unrivaled in the US as compared to other places. And one of the problems that we have as humans is we have recency bias, and we have a tendency to frame things in such a way that distorts it. There's kind of the famous line that Richard Feynman said, which is, the most important rule is not to deceive yourself, and you're the easiest person to deceive. So the question is the problem in the US an irreversible structural decline, or are we in a down cycle? What's going on here? If you look back, for example, at homelessness, you can see that in the late 70s, early 80s, there was a huge homelessness problem. Guess what? They reversed that problem. If you were to look at the period of the 80s, New York was terrible. Until you had a couple major changes, it was not a good place to be. It was really awful. But they cleaned up the crime. It became a very safe place, relatively speaking, and it rejuvenated. So to what extent is the US on an irreversible path down, and to what extent is the US in a situation where this is just a cyclical downturn? We can go through lots of examples of cyclical downturns. Heck, the US had a civil war. Not a lot of places have had civil war, but civil war is pretty bad, right? There was, of course, all the civil rights issues that you went through. And so there's not a lack of problems that have existed in the US. A lot of people would say that the US is like the Roman Empire. It's sort of in this falling state. But how can we really know? How can we really tell? I have a friend and client who renounced his citizenship many years ago, and he mentioned to me, said, I'm a trader, and as a trader I view things structurally, and I view it as a structural decline. So I've been thinking about this a lot lately. I've been trying to think to myself, well, to what extent would I be allowing myself to be biased by people around me, by certain things that I tend to fixate on, and underestimate a lot of the positives, because there are a lot of positives. I don't think that a person can be really rational without saying that. Let's just kind of consider some. First of all, there's a tremendous amount of natural resources in the US. That shouldn't be underestimated. It is a vast country with a lot of resources. it has both seas. So you can trade both across the Atlantic and across the Pacific. This is a big deal. Some of the best companies in the world exist in the US. There's a lot of innovation, a lot of entrepreneurialism, a lot of know-how, etc. You also have the state system, and the states kind of have this fairly reasonable balance of power compared to some other alternatives around the world in other countries. So all of those things strike me as being, really bullish, really positive. The US dollar is the global reserve currency. That gives them a lot of strength. For sure, the US military is by far the most powerful in the world. That gives them a lot of geopolitical capabilities. And so, do we have enough negatives to sort of overcome those positives? What would indicate that? And the thing that I have sort of come to lately is I've been looking really at the incentives. There's a famous Charlie Munger quote, which is, "Show me the incentives and I'll show you the outcome." And I think this is probably the single most valuable area to look at. And there's two data points in particular that I view as being very problematic. So I've come around over the last while, been saying that I don't believe democracy is capable of solving the problems that democracy has created. And there's another famous line, actually since the Dune movies came out lately, I believe it's from one of the Dune movies, which is, "All forms of government tend towards aristocracy." I think there's a lot of truth to that. Well, what's going on in the US? A couple things. First of all, there's the rise of passive index investing. And you might say, well, what's wrong with that, Michael? I mean, this is great. Hasn't Warren Buffett been advocating for a long time that you should buy a low-cost index of the S&P 500? And by doing that, you're going to beat the market because most of these hedge fund managers, et cetera, don't, and financial advisors, et cetera, don't beat the market anyway, especially when you adjust for fees. Yeah, that's true. And because of that, it's become more popular. And I think for the individual, at least in the short term, passive index investing is a great strategy. But for the nation, in terms of incentives, I don't know that it is. And this reflects a little bit of sort of, I would say, the decline of value investing. Now, let's quickly kind of define what I mean by value investing here, because Charlie Munger says something which I think also can be true, which is, by their definition, all good investments are value investments. And, so you can kind of play around with that a little mentally. But what I'm referring to here is essentially assets that have become inexpensive. And by buying those and when I say inexpensive, what I'm really referring to is intrinsic value relative to cash flows. Okay, so in other words, if I go out and I say, all right, I can buy cash flow for different prices on the market, in theory, I want to buy cash flow for as cheap as possible. That's sort of the idea, right? Why would I pay, $100 for, $20 a year if I could pay $50 for $20 a year? I would, of course, want to do that, barring, decline in one and rise in the other, right? So in theory, it should come down to cash flows. In practice, does it? Little questionable about that. Of course, there's the famous line, the market can remain irrational longer than you can remain solvent. That's another piece of it. But what you'll notice is that value investing has underperformed over the last long time. And could it reverse? Yeah, of course it could reverse. Absolutely. And I think in some areas, for example, if you look at very, very small companies, for example, I'm buying small businesses doing roll-ups and microcaps and things like this, I think it's a great place to buy. But if you're looking at large caps, things like the S&P 500, I don't think that necessarily holds true. And here's sort of the issue. When you get a lot of passive index investors, what happens? Money gets allocated, and there's two consequences. One is the money gets allocated more money to bigger things. So the bigger something is, the more money it gets, which has a kind of this cyclical effect, right? To some extent, probably the big rise in market cap of Tesla can be explained to some extent in that regard. It joined the S&P 500, therefore a lot of extra money flowed into it. Because more money flowed into it, and it got lots of attention, people were buying it because people were buying it, and it grew bigger, more money went into it from the S&P 500, and you had this cyclical thing. And so the turnover of stocks in the S&P 500 is probably not as much as you would like in this regard. So that's the first part. And what is the effect of that on value investors? The effect of it is that a company that might be cheap simply will not get people to go and cycle into it because they're not allocating money actively. Like, in order for a company to do well, if you just think about what's going on in terms of stocks, what happens? I say cash flows are cheap, so I want to buy that company expecting that the market is eventually going to see this, and therefore the prices are going to rise. The thing is, if everybody's allocating passively, and of course not everybody's allocating passively, but a large number of people are allocating passively, then you're in a situation where there's less room for people to start piling into that underpriced asset and push it up and therefore give you the returns. And if you have to sit there waiting for a long period of time where the index just continues to go up, the opportunity cost in time might actually give you an inferior return, even though on a cash flow basis you think it's a better investment. Okay, so that's, I don't know if I'm making that clear, but hopefully it is for people. I think this is a fundamental problem. And what would normally happen is you would normally have people who are capital allocators go in and they would say, okay, I see this thing is cheap, I'm going to buy a whole bunch of share of it, I'm going to do whatever. Well, the issue is there's so much capital flowing into some of these companies that a lot of laggards just never kind of get swept out the way they should be. And a great example of this is GE, or sorry, not GE, GM, okay? So I have like complete disdain and disregard for most of the CEOs of these companies. I think they're basically rent-seeking trash. That's like how far I would go. So let's just kind of consider here. All right, the CEO of GM had made the comment recently that they wanted protectionism against Chinese automakers, okay? And said, listen, give us a fair market and I'll put our products up against anyone's. This is nonsense. People are just not buying your products. Your products are just not that attractive on the market. That is just the way that it goes. And it's not true that you have a problem that it's not a competitive market with China. You just produce inferior products. And here's the interesting thing. Over the last 5 years, this person has made about $200 million in compensation. And over the last 10 years, the stock price is basically flat. In other words, there is zero shareholder value that has been created. And yet, in spite of this person, they have rent-seeked $200 million in the last 5 years alone. Basically, the shareholders should be absolutely pissed. They should be going into the boardrooms, physically grabbing the directors, throwing them out onto the street, and getting these people out of here. But guess what? You have passive index investing. And in passive index investing, what happens is the majority of the votes are passive, right? These guys, they're being charged, let's say you were talking about Vanguard or something. You're looking at maybe like 15 basis points, in some cases much lower, as a fee. They're taking no active role in the management, the voting, the governance of a company. And therefore, the incentive of the people who are in charge of these companies is to rent seek, okay? Rent seeking likely will destroy America. That would be kind of how far I would go to say. This is like the great cancer of America is rent seeking, okay? And we'll talk more about it in a second. So this is just one example, right? The truth is, this is an infectious disease all over corporate America at a large scale. You have just a tremendous amount of rent-seeking. People who are sitting there who are just kind of gradually trying to extract their value without adding value. And yes, there are some really good entrepreneurs. Yes, there are some people who are building companies very successfully. Yes, there's a lot of that going on as well. But increasingly, the incentives within the system don't encourage this. And what's gone on is that because of the fact that you used to be able to have these activist investors, and you still do to some extent, you've got people like Bill Ackman, et cetera, but the amounts of money required to make a difference are so high, and relative to the total share, as the passive portion of the portfolio grows, that I think that has less and less an effect. And if those incentives are not there, like what should be happening is the shareholders should be driving the board, and the board should be driving the executive team to aggressively push that company to improve. And this is simply not happening. Instead, the incentive is the directors don't want to rock the boat because they want to get another board position on another company. They collect a few of these, they collect a few $1 million a year, things are good, everybody's happy with them. At the same time, the executive team, similar sort of deal. It's really hard to grow a big company, it's hard to deal with all these things. So what do? They rent seek, and they know that no matter what, the investment is going to continue pouring in because there's so much passive index investing going on in the country. I think this is a big, big problem for the US. And is it changeable? Yeah, like that's not an intractable problem. It could be addressed in theory. It could happen that the returns start to become much lower in these passive funds. There's too much money thrown in there, et cetera, and then that might create a recycling. Maybe that could happen, but the question is over what time period, and is that fast enough in order to address the competitive forces that exist coming from a lot of these other countries, right? China being an example if we're talking about automakers. I mean, Chinese manufacturers are just destroying American automakers in that regard, with the exception of Tesla. Tesla's the only one really that's competitive, I would say. So what's the next issue? The next issue really comes down to percentage of global GDP, or national GDP that comes from the government, okay? This is a big thing. So if you sort of think about it logically, What you want in a country is you want to have a relatively small share of the GDP coming from government spending. You're going to have some of it because by nature what's going on is you're having people pool their resources and they're putting them into a common pot. The common pot is then spending on some sort of collective needs, right? In any collective society, and you want some degree of that because coordination is our main advantage as humans. You want to be able to build roads, and you want to be able to have policing, and you want to have things like this, right? So there will be some share of GDP that comes from government. It is hard to say what a reasonable share of GDP should come from government. But what can be said is that if that share grows too large, then it means that a very high share of people are busy getting their livelihood from government spending. And what does that mean? That means it's basically impossible for them to vote to reduce the budgets. Okay, so you sort of think of it this way, like imagine that 5% of GDP is coming from government. Loosely speaking, you could abstract that, you could say, well, basically 5% of people's wages is coming from government. That means 95% of people are hurt by increases in government spending, right? And 95% of people could hypothetically then vote to say, whoa, hey, let's reduce the spending. Now, if you get up to 15%, which is about what it is in some place like Singapore or Taiwan, you're still like it's 85 to 15. It's a pretty reasonable balance. If you're at 25, you're about where UAE is. If you're at some place like 33, you're around what Switzerland is. The US is over 40, okay? Over 40%. By the way, the worst countries are some of the European countries, France, Greece, and Italy, I think it is, at around 60%, nearly 60%. So when that's the case, how can you ever vote to cut spending? You're going to have 60% of the population voting against it. And this is without throwing in all this other stuff, right? Because probably your brother works there, even if you don't, or your sister works there, or your spouse works there, or your parent works there, or your kid works there. It's like it affects just too much of the population in order to vote to reduce spending, in order to cut back on what's going on. Now, quick little sidebar on this, because I'll have to get into arguments with the modern money theory people about it. They'll sit there and they'll say, well, hang on a minute, there's no problem because the government isn't financially constrained. This is actually true, okay, so they're not wrong. The government is not financially constrained. The government can print money, and so, it's not a problem that they're going to run out of money in that regard. The issue is not that. The issue is the incentives that this creates. The incentives that this creates are incentives for rent seeking, right? What happens is that people view government spending as their income, and when government spending is their income, they say, well, we want the government to spend more so that I can make more. And all of a sudden, you have companies and large organizations lobbying, realizing that, hey, actually the easiest way to make money in this situation is in fact to go to the government and to get them to give me money, as opposed to turning around and producing value and selling to consumers, because that's competitive and that's hard. Here, the government can give out money in huge amounts with high margins without creating problems. And that's a really bad incentive. That's a very, very bad incentive. You do not want that in a society, because essentially what you're doing is you're creating a drag on the rest of the system, right? So if you say, okay, we've got people who can run really fast, awesome, great. Those people then can drag a certain amount of people along behind them, and in the wake of that, this can be helpful, right? You sort of like imagine that we're like a caravan moving these wagons down the street. And the guys who can move the fastest, those are the ones who win, right? The ones who are going really slow, eventually the wolves eat them. Well, as you get a larger and larger share of the population who are just riding on the board of these wagons, being pulled by the other people, there is less and less energy moving it forward and more drag. And at some point, that tilts in a negative direction. And as it starts to tilt, more and more people start to say, well, hang on a minute, what's going on here? Like, why are all these people riding for free? Why don't I ride for free? And that's a really, really bad incentive. I don't see how the US gets out of that at this point in time. I think that it is a big issue, and I think it's exasperated by the fact that wealth inequality is growing, and I think that wealth inequality is growing in part because of this problem. So let's just talk about one other little quick thing here, because I think wealth inequality is an underestimated force in the modern world. I think it's like one of the most important trends the next 20, 30 years, and this will be broadly across, the former Western developed world, meaning Europe, Canada, US, Australia, New Zealand, etc. So clearly there's growing wealth inequality. This is not a question. What is the consequence of that? Some people might say, oh, it's not such a big deal, etc. Well, the issue with it is that a democracy really only functions well when you have relative wealth equality. Why is this? This is because of the fact that you know naturally that when you have a majority of people who can vote to confiscate the resources of the minority, they will in some way, shape, or form do this. Okay? So what you want is you want a relatively strong middle class so that a large number of people are hurt by essentially like confiscatory, extractive forces from government. That you want a large body of people who will vote against that. They're going to say, whoa, 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 hang on a second. I don't want you to raise my taxes too much. If you raise my taxes too much, that's hurting me. And as you start to get this polarization, you get a larger and larger share of people who are struggling and they feel the system is not fair. And they look and they see some people who are, you know, much, much farther ahead of them. They say, well, hang on a minute. Let's just take from those guys. Now, if you have an equal enough population, you don't get enough people who are going to vote to do that. But the more you do this, the more the body of people who are going to vote to do that goes up. And we see this to some extent in Europe, right? You look at situations like what's going on in Portugal, for example. And what happens when you do that is you disincentivize those people who are at the top of the pyramid. Now, I'm not necessarily saying that all the people at the top of the pyramid deserve it. That's an inaccurate view. Okay, the truth is there are people at the top of the pyramid who are extractors, they're scammers, they're all this sort of thing. But that's not really the point. The point is that you want to maintain strong incentives. And it's not a good incentive when you have to worry about building something and having somebody else take it. It's not a good incentive when you have a partner there who did nothing or seems to have done nothing, who takes half of what you made at the end of the month. They didn't take the risk, they didn't all this stuff, right? And there's some reasonable portion where people are like willing to deal with it, and there's some unreasonable portion. And when you combine that with the fact that we have the internet today, and therefore people are able to relocate and be in a different situation, they can outsource their labor, they can do all these sorts of things, you end up in a situation where it's sort of an Atlas Shrugged moment, right? For those who aren't familiar, the book Atlas Shrugged by Ayn Rand, very interesting book, idealistic, but interesting book. Kind of is the idea that there are certain people who are very high producers and the rest of the world sort of relies on them. And if you extract too much from them, it'll be like Atlas, who's holding the world, just shrugged and put the world down. And so these people kind of depart. That's not totally unrealistic in the sense that you see these people fleeing countries to go to some other country. You see this in Norway, for example. All these centimillionaires and billionaires are leaving to go to places like Switzerland because the wealth tax is getting raised. It's just like, hey, look, this doesn't make sense anymore. And when you do that, a lot of what made your society so great is gone. And I think that's a structural problem. That's something that I don't see being easily reversible. I don't think that the system is likely to address wealth inequality. I think that wealth inequality is deeply structural and is going to get worse. Interestingly, most of what happens to try and address wealth inequality actually causes more wealth inequality, and it works like this. You have a situation where people say, hey, look, we don't have money, so we want the government to print money to give us money, okay? Rich people, they have their stuff. We need some stuff. Okay, great. Print money. Money goes to those people. What happens with that money? So the money supply just grew, right? And at first, what you see is there's a distribution of that money to the lower class. All right, perfect. Seems good, right? Well, the problem with that is that the lower class, what are they going to take that money and do with it? They're going to spend it on goods and services. Well, where do those goods and services come from? They come from people who own the assets, right? It's the asset owners. And because of the fact that it's going to the people who own the assets, ultimately all that money is cycling back to the people at the top. So people at the top actually, are really big fans of having there be money printed. When you're in a situation where you own lots of stocks, I mean, look what QE did, right? You had this kind of deflationary cycle in the global financial crisis, 2008, 2009, et cetera. And then the stock market had this great, nice run-up trajectory up to 2021. When they kind of finally, at the end of 2021, they brought in QT and, raised interest rates and all this sort of thing. Well, that's great for those people who have money, right? Great for asset owners. So they want that. And so the types of things that are typically being done to try and address wealth inequality actually just exacerbate wealth inequality. And I don't see that governments are well equipped to solve the problems at a deep level. I don't think they're incentivized to. I don't think that people understand the nuances of it. And so I think that problem is just going to continue getting worse. And there's lots of technological reasons, there's lots of reasons why I think that problem will continue to get worse. And it's going to simply exasperate these ongoing issues. So for this reason, my conclusion is that yes, actually the US is at a point of irreversible structural decline. I could be wrong on this. Obviously, I'd love to hear you guys' comments. Put them in the comments below and let me know if there's some flaw in my argument, etc. I don't think that it means that the US is about to go bankrupt or the dollar is about to crash or, you know, it's a society that's about to fail or something like this. I think that actually, if you look at the history of empires, etc., there's a fairly lengthy decline. You can look at, I mean, what was the peak of the Roman Empire? I don't know, maybe like Marcus Aurelius, something like that. Julius Caesar, Caesar Augustus, like arguably somewhere in that range was probably the peak of the Roman Empire. Well, Marcus Aurelius was like 180 AD. You know, it was hundreds of years before the Roman Empire ultimately collapsed, right? So you can have a lengthy period of decline. And by the way, in this sense, I'm not referring to absolute decline. I think that US GDP can and will continue to rise. I'm just referring to relative decline, meaning that on a relative basis, compared to other places in the world, I think that you're going to see that the US is in decline, that more and more it will be attractive for capital to flow elsewhere, for innovation to flow elsewhere, for people and innovators and all that sort of stuff to flow elsewhere. And ultimately, this is going to gradually chip away at the US advantage, which has been there for a very long time. And that as it chips away, you can kind of think of it as, you know, people are always going to want more. And there's one of two ways they can get that. They can either fight for a larger share of the pie, or they can grow the pie. And in this period of relative decline, what it means is people are more likely to fight for a larger share of the pie, as opposed to growing the pie. It becomes harder for them to grow the pie. And that's also, I think, part of this structural problem. So yes, in my opinion, the US is likely on its, I don't think that it's reversible at this point in time. I think that it's, you can make the arguments, you know, Ray Dalio has said, oh, you know, in theory it can be done, etc. I just think that the problem with the incentives is that they work against you. And once you've created that negative incentive momentum, it's going to be very, very difficult to solve these issues. And so we'll see. But I think it's a good indicator that at least people should be considering some other options, being aware. And I'll do another video in the future talking about, you know, if not the US, then where? What are the places that a person should be bullish on? Because the truth is that a lot of the world is in similar problems, or in some cases worse problems, I think, if you look at, for example, most of Europe. So anyway, let me know what you think. Put it in the comments below. I hope you enjoyed, and we'll talk to you on the next video.